Brad Williams, Frugal Finance, a Crummey Trust. The Crummey Trust is an irrevocable trust designed to allow individuals to transfer assets to beneficiaries while taking advantage of the gift tax exclusion. This type of trust helps reduce a donor's taxable estate and potentially lowers their future estate tax burden. The core feature of a Crummey Trust is that it allows the grantor to make contributions to the trust while beneficiaries are given the opportunity to withdraw the funds for a limited period. This arrangement helps avoid gift taxes on the transfer. Key features: irrevocable structure. Once assets are transferred to the trust, the grantor loses control over them, but this can help shield those assets from future estate taxes. Gift tax exemption. Contributions to the trust qualify for the annual gift tax exclusion, provided the beneficiaries are given a present interest in the asset. This is where the Crummey letter comes into play. Withdrawal window. Beneficiaries are typically notified through a Crummey letter when a new contribution is made and are granted a window, typically 30 to 60 days, to withdraw the funds. If they do not withdraw within this period, the funds stay in the trust for long-term management by the trustee. How it works? Once a Crummey Trust is established, the grantor makes periodic contributions which are reported to the beneficiary via the Crummey letter. This letter serves as a formal notice that they can withdraw their share of the assets. This withdrawal right is crucial for the assets to qualify for the annual gift tax exclusion. If the beneficiary does not exercise their rights within the allowed time frame, the funds remain in the trust managed by a trustee according to the terms set by the grantor. Annual gift tax exclusions. For 2024, the IRS allows individuals to gift up to $18,000 per recipient annually without incurring gift taxes. The Crummey Trust allows donors to continue making these annual gifts to their beneficiaries without the gifts being subject to gift tax, as long as the gifts do not exceed this threshold and the beneficiaries are notified of their withdrawal rights. Why parents use Crummey Trusts? Parents often use the Crummey Trust as a way to provide for their children's future while reducing the taxable estate. This allows the assets to be transferred across generations without triggering gift taxes. The funds placed in the trust can also be managed for long-term, providing ongoing financial benefits for the beneficiary by keeping the contributions within the annual exclusion limits. The parents can take advantage of the IRS gift tax exemption. History. The Crummey Trust is named after Clifford Crummey, the first individual to successfully use this approach in the 1960s. When Crummey set up the trust in 1962, the IRS initially challenged the use of the annual gift tax exclusion, arguing that the withdrawal rights did not qualify as an immediate interest. However, after a lengthy legal battle, the courts ruled in Crummey's favor in 1968, setting a precedent that made the Crummey Trust a viable tax savings estate planning tool. Benefits and drawbacks. Advantages. The trust allows for tax-free gifting within the IRS exclusion limit, making it an effective way to transfer wealth across generations. Beneficiaries can access the funds within a specific time, which can be beneficial for their financial security. The trust helps the grantor reduce the size of the taxable estate, potentially lowering future estate tax obligations. The grantor retains some level of control by directing how the assets are managed and distributed. Disadvantages. The potential for beneficiaries to withdraw funds prematurely may limit the trust's ability to grow over time. Establishing and administering a Crummey Trust can involve significant legal and administrative costs. Mistakes, such as failing to send the Crummey letter or not properly managing the withdrawals, can result in the loss of the tax advantages. Since the trust is irrevocable, the grantor cannot regain control over the assets once they're transferred. To address the potential drawbacks, some families place restrictions on how or when beneficiaries can access the funds. For example, they may stipulate that the funds cannot be withdrawn until the beneficiaries reach a certain age or set penalties for early withdrawal. Importance of the Crummey letter. The Crummey letter is critical in ensuring that the contributions made to the trust qualify for the annual gift tax exclusion. Without the letter, the IRS may not recognize the contribution as tax-exempt gifts, which could result in the imposition of gift taxes and penalties. Therefore, it is essential that the grantor or trustee sends this letter every time a new contribution is made to the trust. Contribution limits. In 2024, the IRS annual gift exclusion is set at $18,000 per recipient. To benefit from this exclusion, Any gifts made to the Crummey Trust must fall within this limit. This helps the grantor make tax-efficient transfers while still maintaining control over the assets placed in the trust. Conclusion: the Crummey Trust offers a useful tool for reducing estate taxes, providing financial security to beneficiaries, and transferring wealth without incurring gift taxes. By informing beneficiaries of their right to withdraw funds and keeping contributions within the IRS limit, it offers both flexibility and tax benefits. While it requires careful management and attention to detail, the Crummey Trust remains an effective strategy for long-term wealth transfer. If you are looking at adding a Crummey Trust into your financial affairs, consult an estate attorney. If you have any questions regarding Crummey Trust, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.